Hello everyone, my name is Mayank and I am a certified investment banker and you are watching the Quant. So in this video, we will break down the option Greek and understand how they actually measure a real trading risk, not a textbook theory, right? And yes, we will also see how each Greek is calculated and used practically in an Excel sheet, step by step. So let's talk about something that sound very complex, but it is actually the backbone of modern option trading. That is the option Greeks, right? So most people thinks option trading is just a bet on a price, ups and down. That is the incomplete thinking. So the option are not just about the price; they are about the price, time, and volatility, and the most importantly how fast all of these are changes, right? And the Greeks, they are the dashboard that shows all of this in a real time. So imagine a big bank sell a large call option position and they collect a premium good money upfront. Feel safe at a first, but now comes the real risk. If the stock price explode upward, the loss can be unlimited. So the real question is, how do professionals manage a risk that has no ceiling? And how do they protect profit without blocking a massive capital? So the answer is very simple. They don't guess. They measure the risk, right? And the language they use is option Greek. So every option lives in one or a three zone. First is OTM, out of the money. There is no intrinsic value there. And ATM, at the money, there is a maximum uncertainty. And third one is the ITM, in the money, intrinsic value or exist, right? So this matter because Greeks behave very differently in each zone, specifically near the ATM. ATM is where things get dangerous and interesting also. So first Greek is delta. So delta measure the directional of the risk, right? And delta is the most important Greek. It answer one simple question. If the stock price moves, so how much will my option price moves? So think of the delta like a speedometer. So the high delta is indicates the option moves mostly like the stock, and the low delta indicates the option barely reacts. So the call option have a positive delta and put option have a negative delta. And a deep ITM option behave almost like the stock, and a deep OTM option barely moves, right? So professionals are use data to create a delta neutral position, right? So the small price moves does not hurt them. But here the problem, the delta does not stay the constant. And that bring us to the our next Greek. There is a gamma, stability of the delta. So if the delta is the speed, so gamma is the acceleration. Gamma tells you how fast is my delta are changing, right? So delta can flip very quickly and hedging become unstable. So the risk increase very sharply. So gamma is the highest at the ATM position because probability the flip faster between profit and the loss there, right? And that's why the ATM option are the highly sensitive, that is the highly risk and very dynamic, right? So the bank tracks gamma closely because a delta hedge breaks when the gamma is high. And the next one is a theta. So theta is the cost of time. Theta is the most underestimated Greek. Theta measures the time decay, and every option is wasting a cent. If even price does not move and volatility does not change, right? So that time alone will reduce option value, right? So time decay accelerate near the expiry, and option buyer fight theta every single day, and option sellers benefits from the theta every single day. So theta is the silent force, always working in the background, whether you are notice it or are not. And next one is Vega. Vega is volatility risk, right? So Vega measured the sensitivity to implied volatility, right? Implied volatility reflects like fears, uncertainty, expected future movement, right? And when volatility are raised, so option become expensive, right? And when volatility are falls, option lose the value fast. So the Vega is the highest at the ATM option. This is why our traders are says you can be the right on a direction and you still lost money, right? And next one is RHO, that is the interest rate risk. After the Vega, the last creek of dashboard is RHO, and RHO measure how sensitive an option price is to change in the interest rate, right? So if I say in a simple word, if interest rate are moves, so how much will my option moves, right? Option value are change or option price are change. So for the short-term retailers, RHO often look irrelevant, but for the banks, institutions, and long date options, so RHOR matters. Just because call option benefits when interest rate are raised, and put option lose value when interest rate are raised, but impact increase as time to expiry are increased, right? Why? Just because the higher interest rate reduce the present value of the strike price, right? So that's make future stock ownership and more attractive for call, right? So RHO is quite Greek, but during the rate cycle and policy tab, ignoring it, that is mistake professionals does not make, right? So the calculate and the complete risk dashboard, it is they are monitor all of them are together like delta, gamma, theta, and vega, right? So together they are create a 360-degree risk view. So this is the how banks are log the profit and control the downside and adjust the hedge dynamically, right? So so the Greeks are not just magic; they are the model. And the history has shown when every hedge at the same way and at the same time, a model can be the actually the amplify the risk, right? Greeks are just a dashboard, not a guarantee. They help you to seeing the risk, not a escape to the it, right? And the option are not just a simple price bet; they are the multiple dimensional instruments. And you understand the Greeks, and once you understand the Greeks, you stop the guessing, you start managing, and you trade like professionals, right? And the market does not rewards about the opinion, right? It's rewards risk control, and the Greeks are the language of the control. And so that is the understand the theory part, and now solve the Greeks one by one in an Excel sheet using the real number. So let's start with the calculation part. So first of all, we calculate the data. So the spot price is 48 and strike price would be 50, and RF value is a 5% and standard deviation is a 20%, and the time to maturity is a 20 week. So I have written all the given information, and the standard deviation is a 20%, and square root of the standard deviation is mm, so this is the formula for the call and put option to finding a delta D1, right? So for the finding our D1 value, we can just put in the value in the formula. So First of all, log S by K, right? So D1 would be we have minus 0.11205656, right? So ND1 is our normal distribution. So right. So for the calculation of the output, ND1 minus 1, that is the formula. So that is call option price and put option price for the delta. And similar to the gamma calculation, and spot price is 49 now. So calculate for the D1 for the 41, right? And D2 is delta, which we have find already. Right. So for the calculation for the gamma part, we have the formula first, delta 1 minus delta 2 divided by P1 minus P2, and the second formula, this. So we are solving gamma with the both method, first and second, right? So for the first, we just are putting the values in the formula. So for the second method, first of all, we calculate for the e to the power 1 by 2 square root of t12, right? And divided by a root of 2 pi. So, and second, we find e to the power minus d1 square by 2. Gamma, we just putting the value and as d1 divided by s standard deviation into square root of t, right? Wait a second. Yeah. So that is the gamma with the method 1 and via method 2 that is almost the similar value 0.065, 0.066, right? And next one is theta. So we have the formula for the calculation of the theta, call and put. Similar. We have the similar situation as 0 is a 49, strike price is a 50, RF value is a 5%, and standard deviation is a 20%, and time is a 20V. So simply just putting the value in the formulas and then so right? So we get D2, and for the calculation of theta for the call price, we using a simple formula and calculate all the value one by one. So first e to the power minus RT. So D1 the square. So D1 is also calculated in a gamma sheet. That is the D1. Mm, yeah, that's correct. Right. And for the final calculate the theta is That is minus 4.0532982, right? So yeah, that's correct. By using this formula, right? And the next one is the Vega. So we have a formula and a value. So let's put the value in the formula. And even is we have already calculated in the gamma, right? So there is also a two different method. First is this formula using Vega equal to S0 into root T and dash T1, right? And the second formula is Vega as under root T to the power minus 0 point 0.5 T1 square divided by under root 2 pi, right? So first method we get 12.12326115, that is Vega value, and by using method 2 then we calculate. For this part, e to the power d1 square into 0 0.5 is also calculated in a theta, right? So it is also approx 12.12 and 12.10 by using a different method, right? And last one is RHO. So for the RHO calculation, again, we just putting the values in the formula k into t into e to t power minus rt and d2, right? So there is a 8.90696195, right? So we are calculate all the Greeks, and I have showing all the formula and all the cells. That is help for you to calculate or make a template for this like this. So this is how easy to calculate the option Greeks, delta, gamma, theta, vega, and RHO. So like, share, subscribe to the contest.